Yeah, so Yvette, thank you so much for allowing to help us get to familiarize ourselves with what takes place in terms of like, if somebody wants to kind of like, do some investing, like, maybe for long-term purposes, or others could have an interest of like maybe just like maybe at some point do it as like maybe day traders or something like that. But really, this was for us to kind of like sit down, have a discussion, and talk about like what should we be doing in order to ensure that we can have some kind of an egg nest that could help us down the road. So that's why like really we requested you to come and help us to kind of get started on that road. So for those of you who are joining in the Ugandan community, Yvette Chibuka, I mean, if Yvette, you're gonna remind me your last name, but I don't have to. You will give an introduction of yourself. So yeah, Chibuka. Yes, there you go. Yes, Yvette has done this for the Ugandans in North America, all over like through the UNA program. She was the first one who presented it to those who are on that other chat group for UNA Wall Street investing. So she's always been very helpful when it comes to these issues. So I connected with her and requested her to come and also give us some insights in this space. So Yvette, why don't you go ahead and take over from there? Thank you so much.
Yes, thank you, Noah. And thank you, everyone, to Sangaye. Thank you for the Ohio community coming together today to hear about this great topic. I'm very passionate about it, investing in finance. I've worked specifically in finance for about 8 years. My career started right after I completed my bachelor's degree in economics at the University of North Florida, and I became a registered stockbroker. And I did pass the examinations that the what they call the Financial Industry Regulatory Authority, or FINRA, does examines every representative that's interested in being a part of this industry to become a stockbroker. So I have my Series 7 and Series 63. But don't let those numbers or licenses, speak volumes for themselves, because you don't have to be registered or have these licenses to do well in investing or in the stock market investing. So you would really have to just be passionate and set some time out for yourself to learn a little bit, just like you're doing today, so that you can continue to be well versed and know a little bit more, be armed with knowledge when approaching investments, and know what to look for, especially when it comes to stock picking. And today's topic, of course, is focused on stocks. But I really want us to have an opportunity to talk about getting started, because a part of getting started requires us to open an account. So we'll talk about that too. Of course, picking stocks, how to buy. Then we'll talk a little bit about stocks versus options, and then building your portfolio, what to buy, and also talk about the risk involved in participating in the stock market, because these are all very important topics. And if there's a topic that is not listed that you would like to talk about, you can absolutely bring it up on this call. It's very open. I'm hoping that we can have an open dialogue and we can all share and ask as many questions as we can think of to get most out of our conversation today. And our time this evening is really unlimited. So most of the topics we should go through within an hour's time. But if it takes longer than that, for the examples and some of the things I'll be showing, that is okay if it goes over by a little bit more. So before we jump right in, did anyone have any questions before we get started? Okay, I take the silence as a no, and that is okay. It's never too early to have any questions. So as those come up, we can share. And also, Zoom has the chat feature. So in case you don't want to speak your question, you can also type your question as well, and we can get your question answered. So to jump right in, when we talk about investments, and I'm going to make the screen bigger, there are multiple investments that you can have your hands on. And the financial industry likes to call the type of investments that you have your hands on as asset classes. So, an asset class can be one of these five. So the first one is cash or cash equivalents, which you're probably most familiar with. You have dollar bills or coins in your bags or purses or wallets, and those are really turnkey, which means they're very liquid. You can present this cash instrument at a store or for a purchase and receive or redeem it for something. You can use it to buy things very quickly. So that means it's highly liquid. And the other type of investment asset class are shares, which we're going to spend a majority of our conversation about talking about today. And shares, as we see on the screen, are units of ownership of a company. So, as it shows here, for example, you can be a shareholder and own a piece of Wells Fargo or Walt Disney World or Comcast. A lot of the products that you use every day, the companies that service you, you can actually own a piece of them and get a piece of that pie. And by owning them, these companies may even pay you a dividend, money every quarter or every month for being a shareholder. So, this is another type of income stream, and a lot of our Muzungu counterparts have been investing in shares for decades. They bought companies, bought pieces of companies years and years ago, and they've been passing down these shares from generation to generation. So that is one way that they've really been able to build wealth, our Caucasian counterparts, over the last several years. And it's an opportunity for us as Ugandans to jump into the stock market and participate and become shareholders as well. Another type of investment class are bonds, and you may be familiar with bonds as well. Bonds are also issued by the federal government, but companies can also issue bonds as well as municipalities. Maybe the city of Columbus wants to issue a Series 28 bond to build a new elementary school or build a new park. They will typically issue bonds to raise money for the municipality. So you can also be a bond holder, and bonds also pay you interest. And of course, the interest is variable. It may be 6% for the year, an annual percentage yield, or 5%. And some things that are really nice about bonds, although our conversation won't be about them today, if you are buying a bond, especially a municipal bond for the state that you're residing in Ohio, and you're buying it for like Columbus or a project in Columbus, the you can reduce your taxation, so that interest that the bond is paying you, you'll get that interest tax free when they pay you payments for being a bond investor. So those are some of the nice caveats to reduce taxation, and you can hold bonds, municipal bonds, to reduce that tax burden. Of course, the US government issues treasury bills and treasury notes, as mentioned earlier. Those are other forms of bonds that are issued and are taxed at the federal tax rate. And we also have real estate. That is the fourth type of asset class. And a lot of us on the line are probably already investing in real estate, either here in the United States or back home in Uganda. You might own land or property. So you have that income stream or asset that is also able to be sold and turned into cash, or you could build a property and rent it out to generate an income stream for you on that property. And of course, the last one is commodities. And these, like gold, also examples they give here, wheat, oil, livestock. You can also participate in a commodities stock exchange. So if you want to get kind of creative, I think it's wild, so interesting that you can trade these products, but you can actually trade these physical products as well and participate in the commodities exchange. And one of the newest things that you might have heard about also is cryptocurrency, which is really fake money that is created to trade and be exchanged between two parties, you and someone else. And there are people who are creating databases to store these fake currencies, mining cryptocurrencies, and allowing an opportunity for people to barter and trade these fake currencies. But the really interesting thing is, like Bitcoin, Dogecoin, these currencies do trade, so they've created a value for themselves. And when people are exchanging them, they're exchanging them for real money. Thus, they're now uh, derivatives of real US dollars. So they trade and move up in value and move down in value based on demand, as well as the economic functions of society when we have different recessive things go on in the market. So it's interesting to see how asset classes have changed, especially over time, and the diversity of the assets that you can own. So it's really great if you broaden your horizon. And I know a lot of us on the line are already doing that, but continuing to strengthen our diversification. We're not just invested in one type of thing, but we're invested in many types of things, so we can have or hedge against inflation or potential economic downfalls in the future. As many of us know, these all of these instruments can lose value, but they can also gain value. And the really good thing is that a lot of them, for example, when you hold shares, and the economy is doing well, you can see 6 to 100% or 120% return on your investment, depending on what you invested in. You can see really high returns. And if we're not doing well economically, it's usually a good time to invest in bonds and hedge against the downfall of the rising interest rates and the change in the economic environment, as well as cryptocurrencies. Those are really good to hedge against changes, downward changes in the economic environment. So before we move to the next slide, does anyone have any questions so far on the asset classes? All right, so I don't hear any questions, and that's okay. So when we jump right into stocks, what we're gonna talk a majority about today, I have to give a disclaimer that all of this information is being shared for the growth and the development of our community. So it is not necessarily investment advice, but information that you can take home and use to see what you want to do and how you want to invest for yourself. And if you are investing yourself, we in the industry call that self-directed investing. And that picture at the bottom with the woman looking at the computer and the graphs, that's a reflection of us being self-directed investors. We're taking the time to do the research, to find out, to do the due diligence, as Noah would say, and make sure we're really comfortable with the stocks or investments that we're picking or choosing. The other option to this is to open an advisory account. And that's the picture at the top where we see the women, the two women meeting with a financial advisor. And a lot of people actually take this route and do either both, a combination of advisory or self directed, or do one or the other. A majority of investors do have full-time financial advisors, but you can invest yourself. So if you're comfortable, as we're going to go through the slides, learning this information, you can absolutely do it on your own. But don't forget, there's always a financial advisor, either in your hometown or available. I myself am registered. If you do want those services, I can connect you to the right people to open an advisory account. But don't shy away from doing it yourself in a self-directed account.
I do have a question, Yvette.
Yes.
So for the advisory account or self-directed account, if somebody opened an individual retirement account, the traditional one, or a Roth account, can it be either one of those two?
Yes. Yes, it can. You can open any type of investment account, either as an advisory account or as a self-directed account. And when with my experience at Merrill Lynch, a lot of my clients had both. They had their advisory account, the account with the advisor, and they also maintained a self-directed account where they could play with and see how well they could do. Maybe they could beat their advisor and do better, invest better than their advisor in the self-directed account.
So they have to be two different accounts. You can't do both in one account.
Correct. Yep. There are two different accounts.
Okay.
Yeah, yep. Just like having multiple savings accounts or multiple checking accounts, you'd have multiple investment accounts.
I think, Rose, here, when it is an advisory account, you have given the rights to your advisor to conduct all the transactions in that account. So the only thing that you can do is you just simply look at it. You can view it, but you cannot transact in there.
That's correct. Yeah.
Yes. Now, there is also one other question that I have, Yvette. Some of us, we have kids, right? And like, sometimes we feel like, maybe I can start something small for the kids as a tool to kind of like, incentivize them to learn about like, this entire process of investing at such an early age, because research is that people who start early, they end up building like really good financial assets. I recently read about how Mark Cuban was doing an account with was helping his kid to try and do some trading. So I just wanted to find out can a parent open up maybe a small account which would be maybe self-directed, but in the names of the kid, and have it like the parent being like the trustee who conducts those transactions in that account.
Yes, yes, they can. And that brings me to the next slide over here for account types. So as we look at the different account types, uh, two of them that can be opened for minors or children with the help of the parent can be the Roth IRA, and this is a Roth individual retirement arrangement. That's what IRA stands for, individual retirement arrangement. And if your child is working, they can actually put money away in an IRA and let that money build, and they can choose their own investments or with the help of the parents, and save for retirement at an early age. And one of my coworkers that I had brought up into the company, their parents did that for them when they were, as soon as they started working, when they were young. 16 years. By the time they graduated college, because they kept putting money in, they bought their first home with the money that was in the Roth IRA. So that's a great way for young adults to save money. The other option, Noah, is called the UTMA and or the UGMA. And that is just a play on names, but UTMA stands for Uniform Transfers to Minors Act. So the Uniform Transfers to Minors account, or the UTMA, and the G in the UGMA stands for gift, Uniform Gift to Minors Act. These are custodial accounts for minors that are intended to be investment accounts that you can open, and you can build up the money in the account by investing. And when the child reaches a certain age, every state has a different age, attained age. Some states it's 18, some states it's 21 years of age. The child takes over the account, and the account continues to be theirs even in adulthood. So you can open the account for the purpose of investing for with your child. So that is another way that you can invest with them. The only difference between the two, the Roth IRA is for retirement, and the UTMA is a cash management account. So that is just for everyday investing and does not have to be tied to retirement. The Roth IRA has tax benefits where you can take the gains, the money out of the account, out tax free. But the UTMA and UGMA, you do get a 1099 at the end of the year for the gains in the account, anything that you've sold and gained on if you've sold the investment for a gain. And the parents would just file those gains on their 1040 on the tax return, and you would just add this account to the rest of your tax filing for the year. As long as the gains are below $3,000, I believe, that's okay. Once it's above $3,000, then the child will actually file a tax return for themselves, or you would do it for the child. Yeah, so that's a great question. We can help get our children started early on with investing, and these can be self-directed, where you and the child can manage the investment accounts yourselves and don't need to have an advisor manage the account for you. Did that answer your question?
Yes, it did answer my question. I haven't gone out there to check, like, which financial institutions are offering these ones, whether they can be opened online, because nowadays we are doing a lot of stuff online. So would you know which financial institutions? I think I saw Vanguard offers some of these. I haven't played with the rest of the others to just kind of like, find out. I think that would be good information to talk about some of the financial institutions where some of these accounts like, can be opened, and so that Janet can kind of like, begin.
Yeah. So for the majority, for the child, from the young adult perspective, a majority of the financial firms can open the UTMA. So most of them have no problem opening the UTMA up. But some firms do not like opening up Roth IRAs for children. But I know because of the administrative costs, that's what they say, in opening the Roth IRAs up for minors. Some of them don't offer that as a product, as an account. But I know Charles Schwab does for the Roth IRA. So you should be able to do the Roth IRA at Schwab. I can take a look around if anyone's interested in and see what other firms would offer the Roth. But all of them will be able to offer the UTMA and UGMA.
Another question. For Roth IRA, do they have to wait till age 55 or some retirement age to get the money, or can they get it at any time?
Yeah, they can take the money out at any time. That is the beauty of the Roth IRA. Since the Roth IRA, the money that's put in is already taxed. The money that goes in the Roth have been post-tax dollars. So those dollars are okay to take out at any time. The IRS is very open to individuals taking money out, so those withdrawals occur tax-free. On the reverse is the traditional IRA, where the money that we're putting into the traditional IRA in this account, the money is pre-tax dollars. So this money has not been taxed. So we're putting money in like we would in our traditional 401ks and letting the money grow. But when we take it out, the IRS will tax the money when we withdraw the funds, especially including penalties. They'll include those if we do that before the required age. So that is the traditional IRA.
Yeah, I think I just wanted to clarify one thing on the Roth IRA. The money that you put in, I think you can withdraw after 5 years. So there is a time period, time period. So you have to track how much you are putting in there. You don't want to touch the gain, because the gain is intended for your for your retirement. So they don't want you to touch that gain. I think that is it kind of brings in that element of you have to be able to track, so that when you're taking out any money, before that age that Rose talked about, you have to keep checking, because those ages could be revised. But I think for right now it is 59 and a half. You have to kind of be cautious to make sure that you're not touching the gain in the Roth IRA. But the one that you put in, if say you put in 1,000, right? And now it is 1,500. The 1,000 you can take it without any penalty. But the 500 that will kind of bring a little bit of problems for the IRS.
Okay, thank you, Noah. Yes, that is correct. I didn't add that part, the 5-year requirement, yep, for the Roth. So that the IRS does want you to have the account open for at least 5 years before taking the money out. And of course, there are also outside of the retirement accounts that we've spoken about so far, the traditional and the Roth. There are also individual and joint accounts, and these are considered as cash management accounts. They're just like checking accounts where you do gain interest in the account, and also if you do sell your investments, you receive a 1099 at the end of the year. And they also come with a debit card. So you can go to the ATM with the debit card and pull out money. You can also have a checkbook with these cash management accounts and withdraw funds via check. Although many of us don't really write checks anymore, those are still features that these brokerage firms will give to you for these types of accounts, the individual and the joint cash management account.
So I have one question on the kids account, the UTMA and the UJMA. So you said once they reach a certain age, they can be able to fully take over those accounts, and it will kind of be like a brokerage account for the most part, and they will only be required to file a tax return if the gains exceed 3,000. So I'm thinking in terms of somebody who has got a kid, 19 years, they are going to college, right?
Yeah.
So that kid is no longer a minor at 19, but if they are a student and they are not really working full time, maybe they're just working a few hours, sometimes it's if they don't exceed a certain income, they don't even need to file the tax return. So I'm just wondering, can they take over these accounts and say that you don't have to put it in on your tax return anymore if the gains are not beyond $3,000?
Well, it depends. So for the UTMA and UGMA, the brokerage company will legally not turn over the account until the required age, which might be age 18, sometimes it's age 21, has been reached. So if the state of Ohio says, I don't know your children's names, maybe Noah Jr. Needs to be 21, but they're in college and they're 18, and the state of Ohio says they need to be 21, then you cannot turn over the account until Noah Jr. is 21 years of age. So legally, you would still be managing the account until Noah turns 21 or whatever the age is for the state of Ohio.
Now, do you know a better way to kind of like do the gifting from the parent to the kid? Does the parent have to like, give any like, some form of paperwork to the IRS before they can put that money in? Like, what are the strings attached there? What did you used to see for people who open those accounts?
Yeah, one thing that you could do is, as another option, of course, for creating a way to transfer these assets seamlessly, you can open a trust account, which is essentially an individual account, but it has a legal caveat called a trust attached to it. And the trust account actually has like specified rules that are written out as to how the funds should be distributed and who those funds should be distributed to. And some people like that. They like to create like a complex or really simplified trust agreement where you can pass these assets down to the children either at a certain age or when something happens, like someone passes away, and it's all written out. And that avoids going through the legal probate process in case someone was to pass. You'd have to take it to court. With a trust account, everything's already written out in advance, and that money will move seamlessly from one person to the other or from parents to the children. Another way that you could do it, let's say the child is 18 years of age. Legally, if the child is or young adult is now 18, they can also open their own brokerage account. Legally, that's the age that they can open an account of their own, regardless of whether their accounts are out there for them. And you can gift or do gift transfers and actually transfer shares into their account. You would have, of course, bought these shares earlier and held them in your account, but you can gift them or transfer them to the young adult at a later time of age. And I see a lot of our counterparts do that too. And it helps for tax purposes because it takes away, it doesn't look like you sold that asset and received a gain from it. The entire growth of the stock goes to the child. So the child probably has a lower tax bracket, and if they want to, they can sell the asset or continue to hold it and it can continue to grow. But transferring stock as a gift from one account to the other is another way to reduce taxes and also continue building that generational wealth.
Now, do you know if, say, I made $60,000, but I want to reduce my taxes? So if in a given year I gave my kids like each one of them $5,000, that would be $10,000, right?
Yes.
So do I have to pay taxes on that $10,000 before I give it to my kids, or like, that is something that I can be able to write off?
Yep. If you transfer the stock into their account as a gift, then you don't get taxed on that at all. They will receive the money, and they uh, will be responsible in the future when they sell the investment for the taxable gain or the taxable event.
Okay.
So yeah, you can pass on that taxation to them in the future.
Okay.
Yeah,
Thank you.
yeah, you're welcome. And a lot of our white counterparts do that to reduce the tax burden and keep the money within the family.
Yeah, I think I have seen, I've read through the IRS regulation. I think it is about 14,000 max per person that can be transferred every year.
Yes.
You may want to just simply check those numbers if like, if you're trying to try to plan that route, so you at least you are clear if you open an account like that for the kids, to kind of like, gift some of the wealth there. I mean, like you said, a lot of these people who are pretty established, like, they try to start those accounts and try to have that long-term plan where they are giving away that money slowly, so that the kid will not be just simply one day, like, say if you're not here, they will not be faced with a large tax bill when you pass. So that is something like really to keep at the back of your mind. It may not be for today, but that is something that you may want to think about.
Mhm. Yeah, I definitely agree. And you're right on the money, Noah. This year, it is the tax limit for the gifts is $15,000. Yeah, so it's definitely a good opportunity to continue to move that money, reduce your tax burden. Yeah, so that's really good. And of course, all of these accounts can be opened up at a brokerage firm. So on the previous slide here, I'm just going to move one slide back. We're probably familiar with banks, but when we're opening an account with the broker, it is a brokerage account. So we will open it at a brokerage firm. Believe it or not, a lot of banks have subsidiaries, have opened up brokerage firms. For example, Bank of America partners with Merrill Lynch, and you can have a brokerage account with Merrill or Merrill Edge. And we also have probably heard about Fidelity, Vanguard, TD Ameritrade, and even Robinhood, which is really popular with the younger generation. So these are just examples of some of the brokerage firms that are out there. There are dozens of them. Citi, HSBC, a lot of the big banks also have brokerage arms and can handle opening brokerage accounts. So you really have a variety of different firms that you can choose from. And one thing I know some of us, if anyone on the line has opened an account already, you probably know the variation in these companies really is all about the services that they offer, their customer service, when are they open. Some of them, like Robinhood, they're entirely online. There's no physical office that you can go to versus Bank of America, Fidelity, Charles Schwab. There's probably a local office in your downtown area, and you can see a representative face to face, or call a representative over the phone and talk to them about your account. If something goes wrong or if you have questions for servicing the account. So that's some of the differences that you'll see from broker to broker. I personally do not have any preference. I like to go to the brokerage firm. I switch my accounts from time to time. I like to go to the brokerage firm that is giving me a cash offer, like a bonus offer. For example, for a while at TD Ameritrade, they were offering bonuses of $350 if you opened an account with at least $5,000 or $10,000. So there are different bonuses that each firm will give out depending on how much money you're opening the account with. So that's one thing to consider. And these cash offers are usually require you to keep the money in the brokerage account for at least 90 days, for at least 3 months. And keeping the money there means you won't, of course, take it out within the 90 days, and then they pay you the cash bonus after the 90-day holding period. So these are kind of nice to get a cash bonus while you're opening the account. Robinhood is actually giving out free stock, which is really cool. So you get free stock for opening an account. So that's really nice too. And if you open an account, some of them will also let you refer people. And when you refer people, you can also get a bonus or free stock for referring people. So that's really nice too. You can help others save and invest for the future and also get a bonus out of that as well.
I do have a question right there. Since you said you move your assets, the question is, do you have to divest? Do you have to sell all your stock before you move the money from one brokerage to another? Or can you be able to just simply roll them over like, those stocks the way they are?
Mm-hmm. For most shares, you can roll them over from one account to the other. The only exception is if you have a fraction of a company. There's what we call pieces or fractional shares. Maybe you got a dividend or you sold part of the investment, like a mutual fund, for example, and ended up with a few fractions of one piece. Those fractions cannot transfer. So the brokerage firm will require you to sell those fractions and then you can move the cash. So they don't like transferring fractional shares. The other problem that occurs a lot is that the other company does not want to hold that type of stock. Like, let's say you're investing at TD Ameritrade and you have many, or you've invested in marijuana stocks. Tillery is one, Toke is the other. Maybe it's okay at TD Ameritrade to invest in marijuana stocks, but at Bank of America, they're against it in their policy. As a company, they've decided to exclude marijuana stocks from their investment catalog. That means investors at Merrill Lynch are not allowed to buy marijuana stocks. So that means you cannot transfer that marijuana stock to Merrill Lynch. So that can happen as
Is
well.
this
Where
Sharon? Nze noowa lwaki toli ku meeting? Mhm.
yeah, so Noah, I think that answered your question. Sometimes we can't, for example, move those shares over if the company does not allow. And did anyone have an additional question about the offers?
Not related to offers, but what are some of the requirements the different brokerage companies might ask for?
Yes. Yeah. So the different brokerage companies will want you to have a residential address, not just a PO box. They'll want some demographics about you, like your income, your legal name, your social security number, because they will send the gains and loss information to the IRS. So the IRS gets a copy of what you've gained or lost in the account. And also, sometimes employment information. They want to know where you work, and how you acquired the money to invest. Maybe it was from an inheritance, maybe you sold a property, maybe it's just from employment income. So they want to know that too, because of the Patriot Act. A lot of the dealings that the government found out around 9/11 were that these terrorist groups were using brokerage accounts to launder money. So they do ask a lot of questions to know who you are, a little bit more than opening a bank account. Sometimes some of them will even go to the links of asking you to submit a copy of your driver's license, and 2 utility bills, to show proof of residence. They don't always do that, but you might get randomly selected depending on the company to present those documents. And you do have to be a US resident for most of these companies. The only exception is for Charles Schwab. They have an international arm of the company that opens accounts for not yet Ugandans, unfortunately. So I'm hoping one day they can expand it to Uganda as well. Our African countries, I feel, are missing out on participating in the US stock exchange. But they will ask you those demographical information, those demographics.
Thank you.
Yeah, welcome.
Apologies for interrupting the meeting earlier. I didn't put myself on mute. I'm sorry.
Sure, no problem.
I still had another thing on the accounts there. So you talked about Roth IRA and traditional IRA. If you could go back to that page a little bit.
Yes. Here we go.
Yeah. So per the IRS guidelines, excuse me, everyone is allowed to open a Roth IRA, or they can open an individual retirement account if they are they wanna just invest that money for future use. So you are allowed to open an account where you can invest up to 6,000 if you below age, I think 55 or 50. I stand to be corrected on that one, on the age. But that is another advantage that's you can take, you earn money. I know you putting money through your 401k. You have a limit there of I think about 19,000 maybe, or something like that, 19,500. If you, and then if you you above, you need to check the IRS website on how much maximum you can put there. If you're working with an employer and you're just putting money in your 401k, that particular employer, if you're contributing extra, as soon as you reach that maximum, they will just simply do what? They will just simply stop putting money for that year. So that is the beauty of it. So you can invest up to, I think, 19,500 if you in your traditional 401k, or you can add to that, I think another 6,000 if you are above that particular age, if you're an older person, and then with your employer. But on top of that, you can open any self-directed account or a brokerage account with like, and you can contribute in there, like, up to what? Up to 6,000. The beauty with these Roth IRAs and the traditional IRAs that you are putting the money there yourself. Here you can choose which kind of securities that you really want to trade, like stocks. The limitation that we do normally find when we put money in the 401k with the employer, all the money is just simply invested in funds, right? So
Yes.
that's the limitation. So that's the beauty of opening these other ones. So in these Roth IRAs or traditional IRAs, now once you get your comfort, you can be able to go in there and begin to do what? To like, maybe you like a certain company, like, maybe you like Amazon, you really like, you have read the data, this is a great company. You can now go in your self-directed account, or the one with your brokerage. If you have given it to somebody, you want it to be an advisory, you can maybe dictate some terms like, hey, this is how I want my account to grow, so I would like to have maybe some serious NVIDIA stocks in there. So that's the beauty of opening these accounts. You can be able to do, like, stocks, NVIDIA stocks, as opposed to the 401k or the 403b that is with your employer.
Mhm. That is correct. Because sometimes there are opportunities, like a new company might come out, or you might just have the time on your hands to choose your own investments. You might do better than your 401k and invest with higher returns and higher gains. So the sky is the limit when you do it yourself. But don't forget, I know it's a disclaimer. When you open these accounts, you should put money into them that you're also potentially willing to lose. Just because these stocks, depending on which ones you choose, may not do well. So you also have to always remember that you could lose value immediately, but there are potential gains as well, depending on what you choose to invest in.
And then the other thing that I have realized for so many folks have got the 401k at their workplaces. But one of the things is, like, if you just put money in there, like, you just select maybe a percentage, what is going to happen? Your employer is just going to put that money in what they call a target fund. That is just based off of your age, right? And to me, I always tell people, like, when they just put the money like in a target fund, it may not really be in line with like, your desire for investing.
Yes.
So like, even in the 401k, I would, like, encourage people, like, to go back in there and look at, like, at the 401k. There are some charts in there. If your company is, like, has got like, a good company that is servicing it, you can be able to click on each one of those funds, and you can be able to say, like, oh no, I'm gonna, like, instead of just simply putting the money, like, say, in a target fund, I'm gonna, like, put it, like, maybe in large caps growth. maybe I'm gonna put some percentage of it in like large caps value. Oh, and I will put a certain percentage in one that is tracking the S&P index fund. Those may tend to give you probably better returns depending on your outlook on how you are investing. Now, if like you are approaching like maybe 60, you may want to look closely at your account and maybe try to kind of like say, maybe I may want to pivot to being a little bit conservative. So that is one thing that I have realized, because a majority of us probably we start investing a little bit later. So like if they just simply put that money in a target fund based off of your age, it may not like be able to grow as like the same way that you would have wanted to kind of like it to grow, because maybe if
Yes.
you have started investing a little bit later, I always say like maybe you may consider to take on a little bit more risk, so that you can be able to do what to kind of like maybe position yourself to get a little bit yeah, a decent growth on your investment, because like the concept has always been, the higher the risk, the greater the reward. So you're taking on a little bit of risk, but it could potentially be very helpful for you down the road.
Yes. Yes, that is exactly the opportunity. Mhm. And that brings us into the meat of our conversation to talk about stocks. Because as Noah, you mentioned, if we have the knowledge, if we have the information, why can't we do it ourselves? When we talk about stocks, as we're going to see on the next slide, I'm just going to show this slide first. A stock itself is actually used to be issued as a certificate, a piece of paper, and people would trade these pieces of paper as representation of their share, their ownership in a company. This is an example of a Wells Fargo stock certificate from many years ago. But nowadays, everything has become electronic and digital age. So what is now, what was physical is now digital. And these shares, we see them on the stock exchange just as numbers and symbols versus physical pieces of paper that people would trade. And when you're thinking of these stocks, can anyone name a company that you like? Maybe somewhere that you shop so that we can see if they're listed, if they have stock that you could buy? Feel free to shout out a company or type it in the chat.
JP Morgan Chase.
All right. And I see Amazon in the chat. And we also have JP Morgan Chase. Okay. So one thing that I love to do, I'm going to pull it up here. I love Google. It's really easy to use, very user friendly. So if I type Amazon stock in Google, immediately I will get the details to see the information about Amazon, but I looked for Amazon stock. So here we can see that Google gave me the price, the $3,467 last price of Amazon. And here I can see the chart of how Amazon traded for the day. I can even see the trades within the last 5 days, 1 month, 6 months, or year to date, 1 year, the last 5 years. And here I can see the exchange that Amazon is listed on. Amazon is listed on NASDAQ. That is the name of one of the exchanges. And this is the symbol on the stock exchange for Amazon, AMZN. So that's the universal symbol that Amazon uses. So I can go to my broker and place an order to buy 1 or 10 shares of Amazon, depending on how much money I have available. Then let's say the other stock was JP Morgan and Chase. All right, so here we can see the last price for JP Morgan and Chase and Company was $153.81. And JP Morgan and Chase is listed on the NYSE, the New York Stock Exchange, and the symbol is JPM or JPM for JP Morgan Chase. And below we can see the chart of how JP Morgan traded this day, the last 5 days, and so forth. And what I didn't mention earlier are also indicators, the opening price, the high for the day, the low. So what we're essentially looking at is a quote box or a quote for this particular company. And I really like using Google a lot because it's quick, it's user-friendly, it gives you the information. But many of the brokerage firms that you're going to be using, like this is one of my accounts, this is the Fidelity account. You can also type or search the company and look up a quote for that company and search JPM or JP Morgan and Chase. And they can give you a similar breakout to Google and show you the current price as well as different factors, which we'll talk about in a few minutes. The bid price, the asking price, the opening, the high, the low, the previous close in the last 52 weeks, where was the price, the high and the low. So we can see some really good information really quickly about this particular company and see how it's doing today. Or adjust the chart and see how it's been doing over time and even compare it to other stocks, which is nice. So this is a really quick quote on JP Morgan and Chase. And one thing that I love about stocks is that you can invest in companies that you truly believe in. For example, if you have a T-Mobile cell phone bill, you know your cell service is with T-Mobile, why not buy their stock too and invest in them as a company if you're getting their services? So that's just one example. Or JP Morgan and Chase, invest in the bank because the financial industry historically has done well despite the economic downturns. Investing in companies that you believe in is a really good thing. So here is an example of another quote. This is for American Express. Just like we saw on the previous screen, we saw the last price for JP Morgan and Chase and Amazon. In this case for American Express, it's $16.49. And these are some of the statistics or information that is provided in the quote. So what I'd like to do is go back to the quote that we pulled up for, let's pull up JP Morgan, and ask if you have any questions on the quote. For example, some of the information that we see, does it look like hieroglyphics? Are there pieces that we want to know more about, like the opening price or the high price for the day, low price for the day? Feel free to speak up and ask any questions about the quote box.
Mine is not about about those opening questions. But I just wanted you to touch a little bit about the PE and the dividend yield, if you can, or that is something that you're gonna kind of cover later on.
Yeah, I can touch upon it now.
Mhm.
Yes. So the PE, which is, I'm going to highlight it here, the price earnings ratio. This is a ratio that measures the share price relative to the annual net income earned by the company. So, what it's supposed to show is current demand for this stock, where a higher PE indicates that there's increase in demand because investors are anticipating higher earnings in the future. And if it's a lower PE, investors are not expecting that high of a return for that particular company. The thing about the PE ratio, for some companies, it is not necessarily calculated. Some companies don't have that valuation as an indicator available. So it's not always the most reliable indicator, but it is nice. I personally like it, and it's pretty easy to calculate. If I annotate, I'm going to show the formula of how they calculate that on the screen. So it is the price. Do this here. PE equals price divided by earnings per share. So you don't have to be a mathematician to calculate the PE or the ratio, but they take the $153.81 and divide it by the earnings per share, the accounting figure for JP Morgan and Chase for their earnings per share. And the earnings per share is one of the different accounting measures that appear on the accounting statement. Oh my gosh, I don't know why this is going past my head, Noah, but the are like, oh my gosh, the not the 10K, but the particular schedule, or and it's here too, because Google also gives it out.
You're talking about the balance sheet. If you
Yes.
go to the balance sheet, and then
Uh-huh.
you can look at the earnings section, like financed by capital or that kind of stuff. Is that what you're
Yes.
talking about?
Thank you. Yep, the balance sheet. And sometimes Google lists the balance sheets on the website, on their you search like these companies. Here it does not, but on the company's balance sheet, yes. And you can, most of these companies have investor relations websites. So you can actually go to JP Morgan's investor relations website, and you should be able to pull up the quarterly earnings for JP Morgan. They're supposed to disclose this information, including the balance sheet, to shareholders. That is one of the requirements the New York Stock Exchange makes or requires of these companies that are listed on their exchange to do, so that they can continue to stay listed. They have to document how they're doing. So this information is mostly available There are some stocks that don't provide this information and are not listed on big exchanges like the New York Stock Exchange or NASDAQ. For example, which is really cool, but you can actually invest in MTN. Our MTN back home, they are what we call not necessarily a penny stock, but they are a low priced security that trades on the over the counter market, or what they call OTC, an over the counter market. And these are usually more speculative stocks. In this case, MTN is considered a speculative stock, and you can buy a piece of this company, although it's not traded on a big stock exchange. You can still buy a piece of MTN as well.
I think I just like what I see in as far as the dividend yield is concerned. So it looks like when I look at this chart, it looks like the stock has not really grown much. But I think, like, you know, if you look at that dividend that it is issuing of 5.73, I think that makes you to kind of like, you know, think like, hey, instead of like, you know, buying like, you know, like a bond that may not give me much money, because like, you know, you talk about diversifying a little bit,
Yeah.
like, hey, maybe I can take advantage of that dividend that it is giving. Like, you know, I may not necessarily make my money in as far as the growth is concerned of the stock, but I could be able to potentially, like, you know, harvest the dividend instead.
Yes, that is correct. That is the other feature of stocks that I love. Just as you mentioned, the dividend yield. So this yield, as you mentioned, it's really not bad. 5.73 is a high dividend compared to other dividends. And one thing, I'm just going to move the chart so we can see how they've done over the last 6 months. Don't let MTN fool you, Noah. They in
Oh,
November, yeah, November last year, you could have bought shares at $4. So
man, I would be up. No, I looked at the chart that you put and I didn't pay attention to the duration. So actually it is really good
yeah,
considering the growth and the dividend. That is pretty good.
yeah,
That's pretty damn good. Yeah.
that is good.
Yeah.
Yep. It is, so the dividend is a really great payout. And this is the yield for the year. So you would get 4 payments. Most stocks give out a quarterly payment. And of course, one thing to keep in mind with dividends, if the company is not doing well in this particular time period, they can choose, the board of directors of MTN can choose not to pay a dividend. So that's the downside. It's up to the company to pay the dividend or not. But the good thing is dividend yields are really good. MTN is one. The other company that I love for dividend investing is AT&T. Their dividend is not that bad either, 6.62. But one thing that I really like is that over, let's do a 5-year chart, although they've gone down a bit, they've been really consistent in maintaining their share price. So if you want to get in at a good price and like the offering, AT&T also owns, I think, Hulu. If you look at a company and its product, what it offers, direct TV, if these are products that you see are viable or based on the balance sheet and earnings reports, they're expected to do well in the future because of 5G rollout. They're not bad. They're a good investment to invest in. And it's a good opportunity for you to put your money away and earn a dividend yield, a dividend from AT&T. With I'm without me doing some calculations, let's say you bought, 100 shares of AT&T, and I'm actually gonna cheat a little bit, and I'm gonna go here and look for the AT&T dividend to get the details of what the payout is. Here, this is an article, but there is a web page that's really good. Dividend.com is another good website. Oh, here it is, right on the investor page for AT&T. So on their investor relations page here, the amount was 52 cents per share that they paid out on May, that they are paying out on May 3rd. So if I owned, let's say, 100 shares of AT&T and I got the 52-cent dividend per share, I would get $52 for those 100 shares that I own. So it is a matter of volume. When you look at dividends, you can set a goal for yourself. Maybe you want $5,000 of dividend income every year. Just doing some math to see how much that is. I'm going to divide that by 4 because they pay that 4 times. So each quarter, my goal is 1,250 for the quarter. And if I divide that by the 52 cents they're paying, I would need 2,404 shares because I'm not going to buy fractions. It's going to buy a whole share. $2,404, excuse me, 404 shares of AT&T to get a $5,000 payout every year, or 1,250 every quarter from AT&T. And right now the share price was about $30. So 2,404 times $30. So I would need to invest $72,000 in AT&T to get them to pay me $5,000 a year in dividend as a return on their dividend. So it can take a little bit of money depending on what your goal is. Do you want a high payout or lower payout? But dividend investing is really a good way to also build passive income because you don't need to do anything at all. AT&T just pays you for being a shareholder. All you have to do is own the stock, and all they have to do is continue being profitable and pay you the dividend. So that is another way to invest, and it's passive investing where it doesn't take much, but you can just earn the dividend and receive the money for just being a shareholder. Any questions so far?
Yeah, I think you could have we could have digressed a little bit, but I think this is helpful. The key is I think some of the things you're gonna cover is building a portfolio, like when you're investing, right?
Yes.
So this is helpful. There are stocks that are out there that you will buy that do not issue dividends. So those are ways that you're gonna go out there and you're gonna try to ask yourself what is my goal? What is really my target here? And what kind of risk am I willing to take? So you could potentially pick some growth stocks that are going not to give you a dividend, but for sure that this company is growing, for example, and when I sell that stock, I'm going to my payout is going to be on its appreciation. That's kind of the key there is just knowing there are opportunities out there but you're gonna have to, like, each one of us, like, we have different levels of risk tolerance. So that is really very good, like, showing AT&T out there like that, like, how they can be able to give you that passive income, like, it can be a very good passive income stream for you. So that is like really, really, really pretty neat, because I have seen people, like, who have done their stuff like that, where they have a little bit of the growth, they have a little bit of those ones that are going to kind of, like, just simply give them that dividend income in there, like, rather than, like, like, saying like, oh, now I have to be like really, really conservative, and then you just simply put your money in a savings account, which will not like really give you anything. So that like, takes a little bit of time. It's something like, it's continuous. You have to keep, like, educating yourself in as far as these instruments are concerned, so that you can at least pick something that is always going to put at least some extra money in your pocket. You don't have to be that aggressive, like AT&T, like you showed it there, like, the value of that stock, it kind of like, it has kind of like, maintained the same kind of like, price value. It is teetering between, like, 28 and 30, $31. It doesn't seem like it is growing so much, but that dividend income will be your low hanging fruit that you may kind of want to pick, so that you're not being too aggressive in the market. Like, say for example, you picked a stock that is out there, and it is just gonna, like, it can just simply go up, like, say GME, for example, like, you can see what it did, right?
Yes.
Like, you pick a stock like that, and like all of a sudden, like, it like you bought it at maybe like 250, and now the stock is like, just 140 or 150. Like, it's like, that is the key. It's like, just being careful with your money, doing what is good for you. I'm not refusing anybody to go buy GME, but you have to kind of like, like, know yourself, know your risk. As you educate yourself, yes, you can try maybe to go a little bit aggressive, but like, just knowing where your comfort level is, and then you can pick those good stocks that are gonna, like, like that are gonna be very helpful for you in your portfolio. Like, you really mentioned, like, the stocks that you believe in. I mean, like, you guys are watching, like, maybe you have kids in the house, they watch Disney. I just simply, like, just said, my kids watch these things, why not buy Disney? I believe in
Yes.
it. They will
Mm.
continue. They will continue. They will continue watching these movies. They will continue having all these attractions, and people will continue going there. Why not buy it? I believe in this company. So then I bought it, and like, it has like, done for me very well. I did some research on it, but like, I was comfortable buying it. So like, really, that is really the whole idea. Rather than like, saving that money, you put it in the bank account, and then like, it is not growing. The key is always have your emergency fund. Don't touch that one. Don't play with it to put it in the stock market. But any money that is not for the emergency fund, my 2 cents will be like, try to put it somewhere where, like, it can grow. Because if you don't, the inflation is actually making your money become less and less, because like, the
Noah,
inflation kicks in.
no,
and
hello, Noah.
and yes, ma'am.
Noah, sorry to interrupt you, but
Mm.
you're giving us good information. We appreciate that. But we're here as beginners, but I feel as if you're beginning to take us in the other route where somebody knows what they're doing. Can,
Okay.
can you give Yvette a chance to teach us how to open up these things? Because she told us about self-directed versus the brokerage stuff. Right now, as beginners, we are more interested in knowing how exactly to start. I have
Okay.
my $100. How do I get into that? Thank you.
That's good. That's good. Yvette, you can take it over.
No, and thank you, Noah. I think that that is very important. And one thing that I, as a beginner, that I really liked is that no one ever told me that, and I'm going to actually draw it on the next slide, that I can invest in different companies. As you mentioned, some examples, the Disney, there also the way that stocks are diversified. What you decide to choose to invest in can depend on what you prefer. Do you want to buy a company that a large company, we call that a large capitalized company, or a medium or mid capitalized company, or a small capitalized company, or a micro capitalized company? And this is really looking at their assets, the assets that these companies have. For example, Tesla, which has billions, that is a large capitalized company. So no matter what company you choose, whether it's large, mid, or small, there's always risk in that company not doing well. It could be due to their sector or their industry. Maybe you buy a company, an Israeli company. The political things occur that can also affect how well that company does due to the geopolitics of that region. MTN is also a good example. So we have to really be open to knowing how diversified do we want to be, how open are you to investing in companies with different features or in different sectors. You don't have to invest in different sectors or in different sized companies unless you want to. For example, when the economic downturn occurred, in March, at the beginning of COVID, I saw pretty much all stocks went down, but I saw the retail sector get hit really hard. So I thought it would be a great investment to invest in a company called Nordstrom. Has anyone heard of Nordstrom? You might have shopped at a Nordstrom rack. Yes, a few people have. And back, if I move the chart, here we go. They were in the economic downturn. They were trading at about $15. So this is around May last year, a year ago. And they've literally doubled. They're now back up at $36. They were trading at $15 back in May. So you also have these opportunities to look at different industries, some that are doing well or not doing well. But the one thing I do want to visualize here on the screen, no one ever taught me this, but as a beginner, I wish someone did tell me that I really need to have a strategy. Oh, excuse my spelling. And I also needed to have a plan. So as a new investor, I needed to know what my goal was as an investor to get started. Am I investing for income, or am I investing just to learn the market? And am I also investing to create generational wealth? And I'm putting generational wealth here because I might not see this stock go up right now, but I know that if I buy, for example, a stock of Tesla, in the future, it might be valued at double what it's valued today. Maybe my grandchildren will see the benefits of this stock in the future. So just kind of understanding what my strategy is and what my plan is, and also knowing as an investor how much risk am I willing to take on. That's something no one really told me at the beginning, but as you get a handle and start trading, that's something that you're going to experience. It is kind of like, I don't want to say trial by fire, but when your money is on the line and you see, thousands of dollars just disappear, vanish out of the account because the stock isn't doing well, that's something you have to also be ready for, depending on what you choose to invest in. So one thing you do want to have is a plan so that you can be ready for what is coming ahead. That's something that I would encourage everyone to have, to know what you want to get out of investing so that you can create the right strategy to get the right outcomes that you're looking for. As we saw earlier, we saw the dividend strategy. That's a strategy that you can have as well to provide you passive income as you learn the stock market. And you can also do what we call day trading and look at different indicators to become a day trader and earn income that way if you're willing to take on a lot of risk and learn a lot in the process. So that's just one thing I just wanted to point out. Before I move to the next slide, does anyone have any questions or thoughts? And I know we're taking in all of this knowledge, but as you think about what kind of strategy or plan you're going to have in the future as you get started, just don't forget to always look at the stocks that you're investing with wholeheartedly. For example, you really want to look at the company's fundamentals. Even if you're not an accountant or you're not really maybe well versed in numbers, it's important to look at how the company that you're investing in is valued. Noah mentioned the balance sheet. That is also very important. We also will want to know if this company has ratios that are reliable. We saw the price to earnings ratio. Excuse me, there's also price to sales ratio, the price to book ratio. Those are different ratios that can indicate how well the company is doing. And one thing that a lot of these brokerage companies will do for you is provide ratings. So they also will do the legwork, the research for you, and actually provide you with a rating for that particular company. So as you get started, I'm going to show you an example of some of the ratings that are out there. Oh, I lost my page. I'm going to use this here. And I'm going to log into one of my other accounts. I like Merrill Lynch, Merrill Edge, and their research that they offer as a new investor. Getting information such as ratings done by other analysts is a great way to get information quickly. and it saves time. So one of the things that I found, and I'm going to pull up JP Morgan again and go to their research page. Here we go. And here we can see ratings and reports. Bank of America, Merrill Lynch, has provided this scale, A, B, or C, to tell us whether this particular company, JP Morgan and Chase, is a volatile stock. So do you see a price change? Is that low, medium, or high? And the investment, is it a buy, hold, or a sell? And the income, the dividend, is it going to be the same or higher? Is it going to be lower, or it pays no dividend at all? So ratings are another way to quickly analyze a company, where professionals, these are people that are paid, research analysts, that do the legwork for you to rate these companies, whether it's a buy rating or neutral. And they also provide third-party information. Most of the companies do. I know Merrill Edge does. Here we have Morningstar rating. They have it, JP Morgan, listed as a hold. It's up from 2 stars. It is now 3 stars. And CFRA is also listing it as a buy, up from 3 stars, and now they're rating it with 4 stars. And they give you research reports. You can actually download reports and get technical information. Here we can see their market capitalization, their price as a ratio of their future value. And we can see a really good, robust breakout. A lot of these charts are very technical, but they do give out a written description of the analysis, which is nice. And you can see who the analyst was that created the report and when the report was created. So I think that's also helpful if you're new. You can open an account and take advantage right away of the research tools that each of these companies have to offer. The research tools are free, so there's no cost in opening an account and using the research tools to first research the company without putting any money in the brokerage account whatsoever. And then you can research the companies and see which ones you want to be invested in, and then decide where you do want to put your money. So that's one thing that you can do to also save you a little bit of time. But of course, if you're ready to get started right away, you can put money right away and buy a couple companies, and then see how well they do over time, and take on that risk. That's okay too. But using the research pages that each of the brokerage companies provides is a really important and first step to do. And I just like the way Merrill Edge has this research laid out, because it's really comprehensive. Fidelity also gives a really good research page. Fidelity has a good research tool that you can use. And all of the tools are available for you free of charge without putting any money into the account. You do have to open the account so you can get access to the research tools. And of course, one thing that they do have are screeners, investment screeners. And that's another thing that I like using too, because the investment screeners also give you ideas on different stocks that you can invest in. They will show you different investing themes, stocks that have moved up, market movers, looking at different sectors. They give you different slices of how sectors are doing, and you can click and actually research and see a robust list of different companies based on where you want to put your money. In this example, I clicked on the communication services. There are over 494 stocks that I could buy. And I can see all 494 of them, and put some additional parameters on the screeners, and look up basic criteria. Maybe I want a stock that is between $5 and $10. So I set that as a parameter. Maybe I want the stock to pay a dividend of at least 4%. So I would click here. And you could also manually enter some of these, as you can see. And here it starts to list out some of the companies that fall in the criteria that I've selected. So that's just something to think about. Get your account open first. That's my first recommendation. And then start to do research to learn about these companies and see where you might want to invest.
Hey, this one has a problem. This door.
So far, do we have any questions?
Yvette, I wanted to find out, does Merrill Lynch have the price target? Sometimes the analysts will give you a price target for that particular stock, like if it is possible. So I was just trying to see whether they have that.
There is a Trefis price target. They use a third-party vendor called Trefis. Here we can see on the far left, and they put it in, it's kind of hidden. Let me scroll back up here. And here it is. So here we have $162.97.
Yeah, if that tool is not there, I mean, you read all the rest of the other stuff. There are other free stuff that you can use out there. You can just simply, for example, put the stock in MSN, right?
Yes.
Say, for example, you can just get JP Morgan Chase there, that the one that you're using. You just go to MSN and you can plug it in. And then you will be able to see, what the analysts are saying, that would be like the price target. I mean, those are some of the things, if you're not very savvy with investing, those are some of the things, you can look at, hey, if I have 12 analysts that look at this price, this stock, and they are giving a price target of this much, then even though I'm not savvy, I would rather take a bait and say hey, if 7 of them are saying this is a buy and they are saying the price target is this much, then I think this is a good stock for me to buy. I'm just trying to say we need to take the fear away from this stuff. It's this stuff is doable. If you go to MSN, you go to money, for example, there's a place there that says money. You can go to, has a place that says money on the MSN website.
Okay. And thank you for sharing this, because I personally don't use
money.
Money. Okay.
So if you go there, because I mean, that some people have been some of this research you have to pay for it and all that kind of stuff.
Exactly.
But if you put in the stock, yeah, you don't have to pay. Say, you put in JP Morgan there, you pick it up. So over here, you go to analysis down there. It's gonna give you a price target for the stock. So you'll be able to kind of like, to see that information there. Did you, you should have clicked analysis. There is a section that says analysis on the top right there.
Top right.
No, like just scroll. Right down here, like, you have summary, financials, analysis.
Ah, yes.
Yeah,
Okay.
click
Here
right
we
there.
go, right underneath. Okay.
Uh-huh. So you can see right here, there the year price target for JP Morgan Chase. Like, 14 analysts are saying, like, this is a buy. We anticipate that this stock could, like in a year's time, it could be in the upwards of 168. Like, that's what they are trying to indicate. So like, you don't necessarily have to be too much savvy and going to calculate this stuff. I never calculate this stuff. It's like, it's I read the information and I just simply use some of these tools here, and I'm like, yeah, several analysts like this one. How many analysts looked at it? 14, like, 14 plus 7 plus 24 plus 7, right?
Yep.
So you have like, 31 analysts that looked at this client, at this particular company, and that is the rating that they are giving this particular stock. They are giving it as a buy. 14 are giving it as a, technically 19 are giving it as a buy. The 17, they are saying that they are not adding to their positions, but they are not selling either, right? That's what that hold is saying, right?
Yeah.
Yeah. So like, why are they holding? Why are they not selling? So you see what I'm saying? So literally there is none of them who is saying like they are selling. They are holding on to it. So like, that is gonna give you a little bit of confidence. Like, yeah, I think this one, like, this stock, I can maintain it in my portfolio. Those are some of the tools that you can use out there. Aside that, like, somebody is doing the legwork, just like Yvette mentioned. You use those other charts that are there if you open the account. But like, these are other tools that you can use if you opened an account with Merrill Lynch. Then you can be able to use some of these tools to kind of like, help you just get a little bit confidence. Sometimes you need somebody to kind of like, take that fear away a little bit.
Exactly. Yeah, and I encourage everyone to open an account just to get access to the research tools, but also MSN. No, as you've pointed out, this is very good. Everything is consolidated, but most importantly, it's free. This is free information that you have access to on MSN Money. Yeah, this is good. Thank you.
You're welcome.
So far, we've had a really good introductory conversation on stocks and getting to understand what they are, where, what to look for, what we can buy. There's a lot of research that's also done for you, but you can also, as we see, do research ourselves. Also, there's technical analysis where you can follow the charts and watch how the stock is trading to make predictions, predictive analytics on how you want to buy or sell the particular stock. That's another strategy that you can take and learn how to trade a stock. So I think that helps us create a foundation, and we can all try it out and actually implement our plan. Do we want to do this for learning? Do we want to go right in and make some money? Maybe buy some quality stocks and put them away for a long time? Or we want to take on a lot of risk and buy some stocks that are speculative. So there's really a whole universe of opportunity that we have. So right now, I want to stop and ask if there are any questions before we go any further, because I know we've been talking for about 2 hours now. Okay, and no questions, that is okay. But I do want to ask a few people in the audience. Patrick Kitenda, if you can come off mute and tell us so far what one thing you've taken away from the conversation and what is your strategy or plan after this call? And Patrick, don't be shy. If you don't want to chime in, that's okay. How about Juliet? Juliet, if you can come off mute.
Wanji, yes, please.
Yeah, can you tell us so far what have you picked from this call that you want to do after this call, and what is your plan or strategy?
So far I have an overview of what of the different asset classes that are there. And out of this, we've talked about the shares. Between you and Noah, I've picked out that you must have a strategy, like when you are explaining the dividend thing, that opened up my mind and showed me what route I can take. And I was waiting to hear about other strategies out there, but so far I've kind of understood the dividend strategy, because I think I've seen little checks coming in from the previous jobs where I worked, but I wasn't really paying attention to what they were, just using the money. So moving forward, I think I'm gonna look into that, and I'll be bothering you or Noah to give me more better direction on how to do it.
Wonderful. Thank you, Juliet. And speaking about other strategies, I do want to show 2 more strategies before we end our call. One of them is also a very passive way to invest, and that is mutual fund investing. So we saw stocks, we have an idea of what they are and how they work. They move, up and down in value. But when we invest in a mutual fund, there is a manager, mutual fund manager, that actually does most of the work for you, 99% of the work for you. And they get to pick the stocks that are going to be in a basket of what they call the mutual fund. So let's say the Dodge and Cox mutual fund may have Apple, it may have Target, it may have T-Mobile, it may have Kroger, all these different companies. And the mutual fund manager will pick them for you, do all the work. The mutual fund does also go up in value, it can go down, but because it's picked so many different stocks, a variety of stocks, if a few stocks go down and the others go up, it will still see an increase over time because the manager has picked a really good basket of well-performing stocks regardless of the economic market that we're in. So some mutual funds have done really well. There are different share classes, different types of mutual funds that you can buy. And some mutual funds specialize in investing aggressively or investing conservatively. Some are also focused on international markets. They have different themes that they're focused on. So you have a variety of different ways that you can invest. But the mutual fund just takes a lot of the work out. So you don't have to pick your own stocks. The mutual fund manager picks the stocks for you. And some mutual funds also pay dividends monthly. So you can get a monthly dividend and a gain, a capital gain at the end of the year based on how well that mutual fund manager has done in picking high performing stocks that have done well for the year. And not to boast the Merrill Edge company again, but I like their website, and they do have a mutual fund screener. So it's really nice. You can also, Fidelity has something similar. You can actually use their screener, the mutual fund screener, and actually look up different mutual funds based on characteristics. As we mentioned earlier, the objective of the fund. Some of the things we haven't talked about are the categories, the fees. Some funds have expense ratios as well as loads that are attached to the fund. So let's say if you're going to buy $1,000 worth of this particular mutual fund, is there going to be a fee upfront, a backload, a level load, which means it's leveled out through the duration of your purchase? That fund already takes that load into consideration. Maybe there's no transaction fee, there's no load at all. So there are different characteristics that you'll want to consider. And also the fund family. There are different mutual fund companies. There's, as we see here, Abbey Capital. There are American funds. There's Dodge and Cox. There's Berkshire Capital Holdings and BlackRock. That's another popular one. So there are so many different mutual fund companies that are operating. And you'll also want to choose a mutual fund, possibly based on how well that particular company has done in managing funds. Vanguard is another. And depending on where you have your account open, for example, if you have an account opened at Vanguard, you might have access to more mutual funds at Vanguard that you can invest in that they are not allowing other people to buy at other companies. For example, at Merrill Lynch, I might not be able to buy a specific Vanguard fund because it's only offered to Vanguard clients. So that's also something to consider. So if you like passive investing, mutual funds may be the way to go for you as an investor to invest. It's really also about the yield that you'd like to see. From my experience, what I've seen over the last like 8 years or so, most mutual funds will pay between 2 to 4% a year. So the yields on mutual funds are slightly lower compared to aggressively buying the stocks yourself. You might have better outcomes if you had bought Target yourself or Kroger and invested in Kroger in your own account versus buying a mutual fund that has Kroger in it, you would have seen more returns on that investment alone versus getting the mutual fund. So that's just one thing to consider. But the mutual funds are really hands off, and you can invest passively without having to do a lot of work to generate income or grow your account. How are we doing so far?
I have a question.
Yes.
So what should I be aware of the no load fund? Is there something I should be aware of when I'm investing in those?
Yeah, honestly, the no load funds are just as good as the load funds. They're just a cheaper way to invest in the fund over time, in my opinion, compared to buying a fund that has a load.
Thanks.
Mhm.
And so I have a question as well. So is the load fee incorporated in the expense ratio of the fund?
You know, I don't know the answer to that question, but I want to say that it's not included in the expense ratio. That should be uh, a separate characteristic of the fund.
Okay.
Yeah.
Yeah, I just wanted to mention that because like, yeah, I just wanted you to touch on that because like, like you said, when you invest in, when you pick a fund, you're not like picking a stock, right? So it's the manager is doing the legwork,
Yep.
but like, the key is that you have to pay attention to the expense ratios and the other kinds of costs that may be associated, because that may eat into your profit in that investment. So that is like really, really key to look at those expense ratios if you choose to select the funds.
Yes. Yep, that is correct. Because the expense ratio can eat into your earnings. So that is very important. Yeah.
Can you explain what that expense ratio is because for beginners? I mean, I know it, but like, there are people who may not know.
Yes. Yep. So for mutual funds, when you look at the expense ratio, it is, I like to think of it as an annual fee. It's expressed as a percentage, as we can see here. And this annual fee, for example, if the expense ratio here is 1.28%, so we'll be paying like $10.28, if my math is right, for every $1,000 we invest in. That is the annual fee for being an investor in that mutual fund. And the expense ratio helps to pay the bills. It adds up because there are many investors in that mutual fund. So that $10.28 adds up for the fund to collect. But that is an expense to you as an investor. Yeah, so that's a good question.
The other thing is for funds, like, if you could touch a little bit the difference between funds and ETFs, because like, they have like, kind of some similar characteristics, but also they have some differences in them.
Yeah, yep. So, and I'm gonna write this out so that we can see it on the chart together. Here. I'm a very visual person, so I hope. Okay. Oops. To explain what they are, so we know about what the mutual fund is. It is a basket holding several stocks managed by a mutual fund manager. But when we look at an ETF, we call that an exchange traded fund. And it is also managed by an ETF manager. So they both have managers. The ETF also has a collection or basket of individual stocks. And both of them can also have bonds as well, stocks or bonds. The difference is that the ETF, the exchange traded fund, has a market price. You can actually buy and sell an ETF just like a stock. So let's say you want to get into the energy, renewable electric energy, you can buy an ETF and it's going to trade just like a stock. It will have an opening price, a high for the day, a low for the day. You can look it up on Google and get a quote for the ETF. And when you trade, you buy or sell that ETF, it acts just like a stock. How are we doing so far?
I have a question.
Yes.
Is that what Stash does? Are you familiar with Stash? Do they just do ETFs most of the time?
Yes.
Okay.
Yes. Yep. Yep, they do. Yep. And the difference between the mutual fund is that you have to buy into the fund. So you and the ETF continues to trade. It's an active thing on the stock market, but a mutual fund does not trade up and down on the exchange. It does change in value based on the stocks that are in the basket, but you buy into it and you are part of the assets under management of that fund. So it's not trading on the market like a stock would. It just holds the stock.
Yeah, I think for me, Yvette, the way I just simply look at it, it is simple, right? For
Yep.
the ETFs, like you just simply said, it is just like a stock, right?
Yep.
So if you click sell,
Yes.
you're gonna see whatever you are getting from that trade at that particular time,
Yes.
or how much you are buying it at that particular time. The trading hours are from 9:30 to 4. So if you click sell, boom. If it is $1,000 that you netting at that time, you're gonna see it. For the mutual fund, your settlement is going to take place. You will click, even if you click during the trading time, you're not gonna see your money until the market closes. After hours, they will go balance the books and then they will say, on average, this is how it performed. This is what we will give you. So it's going to take the average for the day and it will settle and it will give you the funds. I think to me, that is how I just simply simplify it. I hope that helps.
Yes, I like that. That definitely does, because of that basket, the basket of stocks in the fund, we wait until the end of the day to see where the fund landed and how much money you're actually going to get. I like that example. Yeah. And the
Also,
go ahead.
Okay. I was going to say that ETFs tend to be cheaper than mutual funds as well, as they don't have some of the fees that mutual funds have, like the 12(1)(b).
Yes, yep, there are less fees. It is a lot more cost effective and tax efficient. Yeah, I like this. This is good.
Now, I wanted you to also touch a little bit on bonds, if it is possible, like, so you set up this account, you have a strategy, and you say, I want to buy some stocks. I want to put in some ETFs or some mutual funds, because you don't want to go out there and just simply buy one thing. So depending on who you are, like, you want to set up those things, like, I'll just keep adding in. And I remember Julia talked about, like, she has seen those checks coming in, like, from the dividends. There is a thing that you can be able to set it outside that those dividends are reinvested, like, those to kind of, like, instead of receiving that money, because once you get it, probably you're gonna go put it in the account. But maybe your intention was, like, you really didn't want that money to come to you. You wanted to reinvest it. So can you kind of, like, touch a little bit on some of those things, how we can be able to have that money just reinvested by us not receiving the money? And like, if we wanted to throw in some bonds in the portfolio, what do we do? How do we find those ones so that we can be able to do that as well?
Yes, yep, yeah, those are good. So for reinvesting, dividend reinvesting is a feature that most brokerage accounts offer. I haven't come across a brokerage account that didn't offer this. So no matter where you open the account, your account should let you reinvest the dividends that you're getting, whether it's a mutual fund that's giving you a dividend, or it's an ETF that's paying a dividend, or just a stock. You can ask your broker to reinvest those dividends for you. Usually it's one of two ways. Either you would pick up the phone and call your broker, and the customer service operator on the other end would submit the request and get the dividends reinvested for you. They would do it with you over the phone, that one-time conversation, and then they'll keep reinvesting it because of that one-time request. Or I know Merrill Lynch lets us reinvest online. Now, if I can find where it is, here it is. So here on this website, it's under accounts, and I click dividend reinvestment. And with Merrill Lynch, I can do it online. And I'm just choosing one account. And here, I'm clicking, here I can click reinvest cash and capital dividends, capital gains. So here I can actually select this option and reinvest all of the dividends. If a stock does not offer dividend reinvestment, then that option is not available. But you can put all the money that you're going to get as a dividend back into the stock, and reinvest dividends and capital gains. And once you submit the changes, that will process on the next dividend payment, so that the portfolio will be updated. And Noah, as you mentioned, it's a great way to also passively invest. You're building up that stock little by little. Within 5-10 years, it's like keeping the change. You get to grow that stock from, let's say, 100 shares or 50 shares to like 200 shares or 300 shares, over time, with doing nothing at all but reinvesting dividends. So that's a great passive way to build the account as well. And so I think that answered the first question that you had. And the second question?
That was about bonds. If
Bonds.
somebody wanted to throw some bonds in their portfolio, like, you know, like as we grow, we kind of want to keep an eye on our portfolio to kind of like, you know, moderate it so that like, you know, the risk that we are taking on is like, you know, is something that is acceptable. Because I mean, like, you know, if you are approaching your 60 and you had your money in just like, you know, just stocks, but if they all go down, then like, you know, you may never recover. So like, you know, that's kind of like, you know, by the time you start drawing, that's what I'm saying, you will recover. But like if you just like, you know, left it there for the next 10 years, probably the market will come back up. But like, you know, you may want to start drawing that money like maybe in 5 years, which is not 10 years, right? So it's good to kind of like, you know, make sure like, you know, you always are looking at your portfolio to kind of like, you know, making sure that you have risk that is acceptable to you. So if you could be able to show like, you know, how we could be able to throw in some bonds in our portfolio, that would be great.
Yes. Yeah. To me, I'll be honest, the easiest way, in my opinion, to throw a bond in your portfolio is to consider a mutual fund that has treasuries in it. That's quick and easy and very passive, and you don't, because over time the particular bond will mature. If you want to set it and forget it, and you want to stay and keep a portion of your portfolio to have a bond holding, I think a bond or mostly bond invested mutual fund is a great way. Believe PIMPCO is the name of the company, PIMPCO Total Return, and it kind of saves time from having to go back and buy a new bond each time it matures. But you can buy a bond, what we call fixed income, and add it to your portfolio directly without it being in a mutual fund. This is just an example from this Merrill Edge account. And here, let's see, let me type Target. And it's nice because they have a screener that you can use, but they make it really easy if you might know the bond already that you want to invest in. I'm just pulling up one as an example. And here, oh, not available. But Merrill Lynch is very picky, so we might not actually be able to see one go through. Oh, shucks. And search. Okay. But to me, it is a lot more involved in, let me go back, in searching for a bond than it is for a stock, because there are a lot more things to consider. First, like, you could buy a treasury, you can buy a note, that's another type of bond. You can buy a bill, that's another type of bond. You can also buy a corporate bond. Oh, they're all here. Yeah, municipalities, treasuries, bills, the corporate bonds, and agency bonds. But let's go through this together. Noah, do you have a preference in corporate, treasury, agency, or municipal?
No, I have no choice, and I'll be very honest with you. As far as I'm concerned, at my age right now, I'm not doing no bonds. I'm
No bonds.
purely equities.
I
But
have
that
a
is something that.
preference. Can we talk about the treasury?
Yeah, let's do a treasury. Okay. All right, and Ben, would you like a bill, a note, or a strip, a treasury strip, or the inflation index notes?
Let's do the bill.
The bill? All right. And any preference on yield? Okay, so here we have 7. So right now the treasuries are yielding 0.02%. That's quite low.
That is ugly.
Yeah. And I don't have my knowledge with me right now. But let me look it up really quickly. I think there's a reason why, because treasuries mature in a certain amount of time versus notes.
10 states.
Okay. So 52 weeks is the common maturity time frame. And looking at the current rates right now for current interest rates, I see why they're low, because within 52 weeks, we're not really expecting yields to go up. So within this year, the Fed and the commissioners were expecting possibly in the next year or two, but they're holding these rates steady, so it pays so little. And if anyone uses an easier method to search for bonds, please let me know, because to me this is just very involved, which isn't a bad thing. So for Merrill Lynch, they're not issuing any treasury notes right now. There are a total of 7 bonds that they have. So it looks like none of them are treasury notes.
There you go.
So those were bills, agency, and yeah, that's it on the Merrill Lynch website. And what bonds are available is dependent on the broker that you choose. So just because there are only 7 available on the Merrill website, there might be more available at Fidelity or Schwab. The reason why is that these bonds that we're looking at are actually traded on a secondary market. That means they were previously held by someone else, and we are now a secondary buyer. We are not the primary buyer going straight to the treasury or the agency to buy them. We just kind of get whatever those clients are selling back to other people, which isn't really fair in my opinion. But I'm curious to see what bonds are available at Schwab and Fidelity, just to compare.
I have a question. Will you be able to share the PowerPoint?
Yeah, yes, I will. Yeah.
I think you've done a good job there. I didn't want you like really to consume a whole lot of time, but it is something that maybe we can cover at a later point, talking about like, you know, fixed incomes a little bit
Yes.
in looking at our portfolio. But I wanted you to show us the quicker way for a person like me when I want to consider, like, you know, having some of my holdings in fixed incomes where I can be able to go and pick a mutual fund that is heavily weighted with bonds.
Yes. The really nice thing that mutual funds do is provide a document. The document is called a prospectus. And that prospectus that the mutual fund provides allows you to see what is inside, what is held in that mutual fund. The mutual fund companies are required to show this, make a prospectus available to investors at least every 90 days, like every quarter. And they only show like the last 10 days of the quarter. So it's not as transparent, but it's supposed to be. It's supposed to show us what they're invested in. And some funds like PIMCO, the fund company called PIMCO, has funds that are set up specifically for bond investing. And here on this screener, the screener I'm using for mutual funds, it has this feature. You can look by objective. What are they investing in by their objective? Here we have the return bonds fund, and we should have a few more bond funds listed here. We have a core plus and a core bond fund. So there are a couple bond funds that are here. General bond funds, US government funds, the treasuries funds. So there are a couple. And this is looking by the objective of the fund. So that's driving their goal. And of course, once we select that objective, it'll give us, let me go back to one of those bond funds we just looked at. I'm going to click on the US Treasury. Okay, here we go. And here's some examples. General US Treasury is the objective. And I'm just going to click on one of them. Any preference? American Century, T. Rowe Price, or Vanguard, or Wasatch?
Go to Vanguard.
All right, I'll pick this Vanguard fund. And gonna go to research. Okay, pretty low expense ratio. And they pay a monthly dividend. That's pretty nice. Okay. Great Morningstar ratings. And ratings, as you're gonna hear, are really important, how the fund is rated. And this is really nice. We can see the style, the credit quality is really high on this fund. So that's good, because you don't want to invest in a fund that's not allocated well.
And right there on your right, if you scroll a little bit up, it shows the total holdings, like, the 5 holdings, like, which bonds are actually in that one, just on your right, the top 5 holdings, like right there. So that would give you an indication of what is in that basket.
Yes, yep, that's right. Yep, we can see the holdings right here. And I'll click this link. Here's our fund summary. And we can see the top 10. Yeah. Yeah, so that's not bad. It's a good snapshot of what's in the fund. All right. How are we doing so far, Noah?
No, I think we're doing good. That is just something to consider. Like, it helps decrease your risk as you try to think about, like, preserving what you have made. So you can, like, if say you chose to be aggressive during a certain period, and now you want to kind of, like, start pivoting to being a little bit conservative. That is a good way to start looking at things like, hey, what can I do in order to make sure that I can preserve this eggness that I have accumulated over time? So that's why I just wanted you to throw that in there. It is a good planning tool, like, already thinking about it. And like right now, you may be just doing stocks, but this may be a good time for you to get yourself up to speed, to try and, like, start thinking about, like, how would I invest in bonds when that time for me to pivot reaches, such that you can start looking at those tools that are out there and trying to digest that information to prepare for that time when you're going to pivot.
Eventually, they will have to increase. And if you have a slice, you've diversified your portfolio to include bonds, you can also gain when they go up as well in the coming years. Yeah, so it is good. Cool. And I do want to ask if there are other questions, because that really brings us to the end of our presentation. Because now, as a beginner, you're probably knowledgeable now in a lot of the ins and outs of opening an account, researching stocks, getting started, and also understanding who you are as an investor. Here on this slide is an example of portfolio, what is called modern portfolio theory, what it looks like percentage-wise to have your account broken out as a conservative investor, moderately conservative investor, a balanced investor, a growth investor, moderate growth, and these pie charts break that model out. Some really smart economist or financial person that I don't know the name of, but I should, created this theory over time. And the colors are color coded, and the yellow is equity. So those are stocks. The red is international equity, international stocks. Blue is fixed income. The blue color is fixed income. And the green color are managed volatility portfolios, which in my opinion could be the equivalent of ETFs and mutual funds, because those are managed products. So if you're not sure how to organize your money once you have your account open and you put money in it, you can actually set up your account based on a portfolio theory and actually create it based on these models to see how it performs. I must admit that most of us on the call might fall anywhere on this scale. If we're younger in age, we might want to take on more aggressive challenges and have model number 5. That's one suggestion. But we might also want to hold on to our money and let it grow at a much slower rate. Capital preservation. Maybe we want to be a lot more conservative, model 1 or model 2. So this is really all about your preference, no matter how old you are and how you want to invest. There's always a way to grow your account and get it started based on what you want to do. These are just examples of how you could do it. But of course, the most aggressive growth I've seen is just 100% US stocks. So definitely don't be afraid to have an all stock account if you want to go that way and grow your money by just investing in stocks alone. It makes me excited to see more people in the community want to become investors and create portfolios. One thing that's not listed here that we might not, I know it's a little later in the evening, we might not talk about today, but we can set up a follow-up call on are risky trading habits like day trading, and also using options to generate income. Options are a high risk strategy, but they do offer a lot of growth in your account and a lot of income in a short amount of time, but they are very risky. So if you are interested in learning or talking about options, we can do that on a follow-up call. But I'd love to open the floor up for any questions, Noah and community, and see where we are in our discussion as we end our call this evening.
What was the question?
Yeah, if you have any questions, you can share those questions now. Or Noah, if you'd like to close us on our call, this would be a good time for us to break, and then offer the community a chance to follow up with any questions. But this is the last slide.
For me, there is only one thing that I would caution. Like, again, like you always gave that a disclaimer. This information is given for you for personal consumption. So you can be able to kind of like, take, like, sit down and like try to see what you can do. The thing is, I would encourage you to try doing this, but I would also tell you, like, don't put all your eggs in one basket. You gotta diversify. Even though you believe in a company so much, I always say, like, it's better to diversify. Don't go and just simply buy one stock. Try to diversify a little bit because you don't want to do it, and after 6 months, you don't want even to do it at all. Then the other thing is just setting those habits, like, you have to be doing it constantly, adding on little by little, because little by little is gonna make that egg nest grow. It's gonna become a bundle sooner or later. You will see 5 years down the road, like, a person who started like with $1,000, they now have like maybe somewhere like 30,000, just because they have created that habit. I just want to say thank you so much, Yvette, for doing this for us. And my request is, like, when I knock on the door, please do it again, because like, this is the best that we can do for one another, right?
Yes.
To kind of like, create bridges to ensure that our community is healthy, in like, well-rounded, well-oiled. So many times it's like, we are not well-oiled just because we lack the information. It's not that we don't want to, but it's just because we don't know. If you don't know something, you can never try. So the best we can do in our communities is like, provide that information so that people can be able to take advantage of the opportunities that are there. Because sooner or later, like, if they start little by little, they will catch up, and they can be able to pass this one down over to their children, and like, they can continue with that legacy, which is very, very good. So thank you so much for taking the time to kickstart us off. I know we're gonna come back with more questions when we start. Maybe each one of us will go out and maybe open a small account and start doing it. There is one thing, and Rose actually helped me on one of the chat groups that we are on. And I was like really curious about, like, how can I be able to buy an Amazon stock that you put out there that is now trading at 3,500? And because, like, I do have a self-directed account, and in that account, I can only buy, like, full stocks. I can't buy fractions. So, like, those are some of the things, like, probably the questions that we will come up with, like, how can I own a piece of Amazon? Because somebody could have seen the 3,500 almost and said, I cannot buy Amazon, and yet I like it. So, like, those are some of the questions that, like, once you begin investing, you ask yourself those questions. and either you go do research or somebody else like you think may have that knowledge is gonna share that knowledge with you and can help you out. So with that, I want to say thank you so much. I also wanted to share one thing about you that